deal with the election. And David, if I'm not mistaken here, you got some good information to show us about each of the candidates' tax proposals, how that's going to affect our bottom line and our pockets. So I'm interested to hear what you got to say.
All right. Well, let's get into the tax proposals. Now, there are a lot of interesting things that have been, thrown in the ring. And one thing I want to mention before we kind of cover any of these is this is their proposals so far, right? Remember, this would have to pass through Congress, and there's going to be probably many iterations to whatever is proposed. Some of the interesting things that may differ from one another is a lower corporate tax rate under Trump. He was looking to eliminate federal taxes on Social Security. So that's a very interesting one. A lot of states out there don't tax Social Security, but there's always been federal taxes on it. They're looking at actually not taxing that. So that would be a little bit more money in everybody's pocket in retirement, should that go through. Eliminate taxes on tips and overtime. Now, the reason overtime is emphasized here is as we move to Harris's plan next, Kamala also wants to eliminate taxes on tips, just there wasn't any language for overtime pay in her proposal. He wants to make the Tax Cuts and Jobs Act of 2017 permanent. To elaborate on that a little bit, that means that these lower tax percentages would be here to stay and would be permanent. As of right now, these tax rates are going to expire at the end of next year and go back to the old percentages from 2017. So you're looking at roughly about 3% more in federal tax if this does not get extended or made permanent. Another big one that is really the reason that the Tax Cuts and Jobs Act of 2017 was so bad for a lot of people is in the top right here, we have the SALT tax, right? It was a limit on how much you could claim on your property tax and your state and local tax payments, right? You were capped at 10,000. This is the reason a lot of folks saw that their taxes increased under that plan where they thought, right, their tax percentages were lower. They thought they should be paying less in tax. So something being proposed is the unlimited deduction for that.
And
Um,
that would include property tax too, right? Because it was a
yeah.
$10,000 cap on property and state tax, which
Mhm.
if you had, let's call it uh $8,000 of property taxes, and then you had $12,000 of state income tax, you had $20,000 of deduction there that you couldn't take, right? Because you were, I mean, well, you could only deduct 10,000. Now that's going to be unlimited in terms of that proposal, right?
Yep. That would be a lot of savings for a majority of people, especially anybody who lives in a state where there is higher property tax or higher state tax, right? Anybody in Washington, D.C., especially, will feel that.
However, they did make the standard deduction super high, right? So it probably wouldn't affect, in my opinion, just analyzing this, folks that are joint filing, because folks that are joint filing have double the standard deduction than single folks, right? And if we look at the standard deductions, they're almost close to what, 13,000 for single, 26, 27,000 for joint,
Mhm.
right? But where I think this salt um, deduction hurt people was that this $10,000 cap, guys, was for single and joint. That was super unfair to the single folks that had the same cap as someone that would have a joint. So from a joint standpoint, I don't think it makes a big difference, but for a single person, I think it's a big difference. And therefore, the single filers would most likely start to itemize again, whereas those joint filers probably still take the standard deduction.
Yep, very good point, and that's definitely true. Last couple of things just to wrap up the Trump proposal here is looking to tax private university endowment funds. There's so many millions of funds that have had preferential treatment here, looking to start beginning to tax those. And then finally, a little bit of a reach here is looking to impose a 20% increase in tariffs on imports. Maybe this could actually be what covers some of those port workers' increased wages. Um, and even looking at 60% on China. The reason for that, as many of you probably know from the 2018 tariff war with China, a lot of that came to the fact that there's a big discrepancy in what we're importing from China versus China importing from us. So there's a little bit of an unbalance there. And then one just very interesting thought here is possibly to replace income taxes entirely with tariffs. Uh, I think that would be a very big reach, and that would probably set a lot of other countries. It'd be interesting to see kind of if that was to take off at all. Um, but I think that could just be something thrown in to make the campaign maybe look a little bit better. But replace all income taxes from all citizens with just tariffs is essentially what that is saying.
Right. Okay.
So let's go ahead and move on to the Harris proposals. And really, there's kind of a few things here that we're going to want to elaborate on, and I'll ask you to actually maybe kind of help out and explain the capital gains and net investment income tax slides here.
Sure.
Now, in the case with Harris, she's looking to raise corporate taxes, right? We want these corporations paying their fair share, and that would be increasing them from 21 to 28%. As I mentioned, they both want to eliminate taxes on tips. So for any service workers, that will really help them out a lot. I know a lot of them have been affected with COVID earlier on, so it's kind of getting that industry in a little bit of a better shape. Raise long-term capital gains for high income earners, right? Those earning above a million from 20 to 28%. Also looking to expand startup expenses for small businesses from 5,000 in deductions to 50,000 in deductions. So it'd be a good thing to help people start a new business, and grow, which will in turn, hopefully lead to hiring other employees and growing the labor market. Now, some more specific ones, taxing unrealized capital gains on the wealthy, right? That means that a wealthy person may have, multiple homes, they might have, multiple investments. And what they've done in the past is they've just hung on to these investments as long as they could, maybe taken loans against them and just passed them on from generation to generation to avoid a lot of tax. And what essentially this is proposing is, hey, we don't want these families, passing this money on from generation to generation and not paying their fair share in taxes. So we want to tax unrealized or investments or properties that have not been sold. We want them to pay some tax on that. One kind of more negative aspect here, and we've already seen this under the current administration, is to look at hiring more IRS agents and performing more audits. And then the final two here is increase the net investment income tax from 3.8 to 5% on income above 400K. And next is to increase the Medicare tax from 3.8% to 5% on income also above 400K. So I'm going to have Neil kind of help out here and explain, a little bit more about
I'm ready.
income tax and the capital gains, just to kind of elaborate on how that works.
All right. So capital gains tax rates. So what are they, right? So let's first look at the proposal. The proposal is to charge go from 20% to 28% for earners above a million. All right. So if we look at the capital gains tax rate schedule, we have it right here, and you can easily see how the majority of folks are in the 15% bracket, right? Now, anything over these amounts, right, get taxed at the 20% tax rate. And then there would be an additional tax ring here, which is the 28% for over 1 million, right? For these. So does that affect us? Most likely not, let's be honest, but it could. And here's why, right? Because the way the capital gains are structured is that it looks at the entire earnings for the year, which is salary, any income plus the capital gain. So let's give a scenario, right? I have a $250,000, or let's do even numbers, $300,000 salary. All right. I sell a home that isn't my primary, but I sell a home for $400,000, right? Now, in the eyes of the capital gains tax bracket, I have 700,000 of earned money, okay? Which some of it's going to be taxed as ordinary income, which is my salary. Any income is taxed as ordinary income. The $400,000 of gains is going to be taxed as capital gain. Now, the anything under this 584 in the totality of that equation, which was 300,000 plus 400,000, which was 700, anything under that 584 will be taxed at the 15%. So essentially what I'm going to have is $300,000 of my salary is going to be taxed at ordinary income tax rates. So that's probably going to be somewhere in the neighborhood of 24 to maybe even 32% if you're single, right? Then the remaining of this bracket, which would be 284,000, is going to be taxed at the 15% tax rate, which would be that ring there in the middle that I boxed. And then the overage of that, which is 116, is going to be taxed at the 20% tax rate. Okay. That's how that works. So that's how the rings would work. Now, if you sold a big property or big stock and all of that combination went over a million, that's where you would experience that 28% tax rate. But in order for that to happen, right, you'd have to sell something for a really good profit, probably a super expensive vacation home or something like that in that scenario. So most likely doesn't affect a lot of people there, right? Now, you mentioned net investment income, right, David?
Right.
Going from 3.8 to what?
To 5%.
Okay. So that would actually apply, in my opinion, to most families. Because if you look at the net investment income tax, it applies to dividends, capital gains, and interest on your investment portfolio. Okay. In addition to that, it's going to be on gains from real estate that you sell or that you sold for profit. Easily, you could come over these thresholds because this also includes your salary. So if I'm at, let's just do the example of $150,000 in salary, right? And I have investment income that includes capital gains. I sold stocks, bonds, whatever, and I had $100,000 of interest, dividends, and capital gains. All of the stuff right here that I just underlined was $100,000. And let's say I file single, right? Let's say I file single. That's a $200,000 cap. That means the combination of my salary and my net investment income will be 250. So then what do? I subtract the $200 threshold. And so what that means is 50,000 of my 100,000 income is going to gather an extra 3.8% tax right now. Right now.
Mhm.
Now, if this changes, that would be a 5% extra tax on that extra 250. So this tax could actually affect many, call it average American earners out there that have the normal interest and dividends and capital gains and such that they have from investments or real estate. So this one definitely will move the needle on what you pay for tax. It will make tax planning that much more important on what you buy and sell and what you shield from taxes in terms of tax deferred investments and so forth.
Mhm. Great explanation. This would, also impact anybody doing Roth conversions and things in retirement, anybody with non-retirement investment accounts. And this would also potentially impact some decisions on property sales. So it's
Yeah.
something that you're going to want to really keep in mind with income. And the one thing I'll mention is, as a married jointly filing jointly couple, it's a little bit easier to hit that threshold, whether it's while you're working or in retirement, especially as federal employees, right? You have a pension, social security, required distributions. And we commonly see this in retirement, actually, with a lot of folks who they have all this income in retirement, they have these required distributions, and they don't need that money. So they save and invest that in a non-retirement account, right? That's the really the main account that's going to generate these dividends and capital gains and interest. And long term, that's where you can get into a big problem. So the importance of doing these Roth conversions and things early is something that can help you to avoid that in the future.
Yep.
So let's kind of talk a little bit about these two tax plans, right? What are the near and long term ramifications, right? Also, who is this good for versus maybe not as good for? So the Trump tax proposal would increase our deficits by 5.8 trillion over 10 years. We're going to talk a little bit later about this when we talk about where taxes are really heading. And I know, Neil, you have a great slide on this to kind of show what the issue is with our deficit. Trump's proposal would help the lower, middle, and upper class in the near term, though, as we can very clearly see with those deficits in the long term, we're eventually going to need to pay for that. The proposal from Harris would increase deficits by 1.2 trillion over 10 years. It would be better for lower and middle classes in the near term, and the upper class would be worse off, obviously due to the couple slides we just talked about, right, with the net investment income tax, the capital gains, but also the Medicare tax increase going from 3.8 to 5% as well. Now, one of the big things that we want to just kind of note here, both of these proposals are increasing the deficit, right? We are on a path of essentially heading towards insolvency that will need to be dealt with. So if either of these proposals pass, you want to take advantage of it, but you also want to, really keep in mind, hey, if these are going lower and we already have an issue with our deficit, what's going to happen with taxes in the future? So that's going to be a major part that we talk about. But the next part is we want to just look at where we are right now in taxes, right? We are at the lowest tax rate since the 60s. And we have known about that actually since 2018, right? When the Tax and Jobs Cut Act passed. We knew that tax rates have been low. And, I know, with all of our clients, right, that's been a heavy focus, or anybody on the line who's met with us, that taxes have been a very, very, very big focus of ours because we have these low tax rates and we reasonably expect those to change in the future. And this really just shows, right, that, if you look at kind of where the average tax rate has been, it's a lot closer to that 25 to 26% figure, right, compared to, looking at the average income of a, 100K individual, 200K joint, it's close to, right, 22% right now. So we have these lower taxes. And, if you could, move forward and kind of share where are taxes going.
Yeah, I mean, it doesn't take a rocket scientist to really figure out where tax rates probably are going to go in the future. I think what it comes down to is no administration wants to raise taxes under their watch, right? They want to continue pushing the can down the road. And that's what we've kind of seen, because at the end of the day, right, most of every single tax dollar right now goes to four things, right? And that's Social Security, Medicare, Medicaid, national debt. Where does all the other expenses we go to? It goes through borrowing, right? Defense of our country, all the programs that we have, all that is coming through borrowing. So at the end of the day, we are the revenue that we have is expected to increase, sure, but so is the outlays. And that's what you're seeing here in this chart. By the year 2033, the deficit will be even greater than what it currently is now by a fairly large margin. So this is the issue that we have as a kind of, let's call it, not an emerging country anymore. We're mature, right? And usually when you start to see these countries or these great powers mature, you start to see issues with debt occur. And we've seen that with Europe, with Greece, these other countries that have struggled mightily with their debt. And when we look at these other countries, right, we could see easily that other developed countries have way higher marginal tax rates than us, right? Looking at most of all of the developed countries that are older than us, we see tax rates 40% or higher. So it's not unusual, or it shouldn't be take us for surprise to see eventually those tax rates also start to creep up for the US.
Mhm.
And I'll leave you with one other kind of idea here about the debt. And this is taken directly from the Congressional Budget Office. Absent any reduction in spending, these would be the levels the tax rates would need to rise in order for the US to not go insolvent. And this is super scary because here in 24, the lowest tax rate is 10%. The median tax rate's 24, which again is the lowest we've seen pretty much in history. And David, you mentioned in the 60s, but that was for a brief moment in time, right?
Yep.
So it touched down maybe at those tax rates for a brief moment in time, but this is the lowest, and it's been the lowest for many years now. 37% is our highest tax run. The computation that they did by 2050 would raise our minimum tax bracket to 19, our median to 47, and our highest to 66. It's not outside of the realm of possibility that that could happen. These tax rates, especially some of the higher ones, have been raised to really high levels in the past. I mean, we have to go back to before the 1940s or before that to see rates like that, but it could happen. But bottom line, even if that's not the situation that we face in the future, there has to be at some point a rejiggering of the tax rates higher to account for that debt and that deficit continuing to rise. And we think the time to really start focusing on this is now, and really focusing on that sweet spot in terms of the tax code. So we've put this together for you guys so you can understand why we're constructive on paying off your taxes now, why David alluded to doing Roth conversions now, and why we've been telling our clients this. But if we really look at this, what we call the sweet spot, why do we call this the sweet spot? Well, we call it the sweet spot because the difference between 22 and 20%, 24% is not much. That's been the lowest amount of change between those two brackets ever. Usually it was from 25 to 28. it was a bigger jump in terms of what you're paying. The other thing too is the amount of income that this bracket commands is super wide, right? So you can actually take advantage of that wide bracket as a single or even joint and start to utilize pushing some money out to Roth before tax rates in the future start to get larger. And the biggest concern that we're seeing across all of our clients, which are mainly federal, is we haven't seen TSPs this large ever. We've had a really good market. We've had huge surge for the US stock markets over the last couple of years, where we've seen really elevated retirement plans that are mostly all traditional based. And so that means come your mid 70s, right? Early to mid 70s, you're going to be sending out a huge sum of money that is required to take out. And that's likely going to come on the backs of some of those higher tax rates, 32%, or by then these tax rates could be adjusting in the wrong way for you. So that's where we're kind of giving you that green light. Hey, please start to look at this stuff now. Don't wait till later. David, is this a slide that you wanted to cover, or did you want me to cover this one?
I think it goes hand in hand with your thought process here, but I can elaborate on it after you.
Sure. Yeah. I mean, just to kind of sum this up is here's the tax rates over on the right side prior to the changes that took place in 2018. It's very easy to see the differences. And I think the stark difference is highlighted right there for everyone to see, which is that $233,000, the 28% tax bracket, right, went to 233,000 for joint. So for joint, people were actually pinched there. Like the single bracket went from 92 to 191, and I lost my drawer here, or else I'd be drawing on this. But the single, oh, there it is. The single bracket was a lot wider, right? But the joint bracket was actually kind of got the bad end of the stick there, right? So that was a super shallow bracket of only about 70K. The difference is now is that joint bracket is 180K and the rate is lower, right? The rate's lower. So, it's a no-brainer in most cases to take advantage of that 24% bracket. That's why we call that the sweet spot.